The purpose of this video is trying to keep you up to date with what would have been done in class today, but given the suspension of activities at the varsity could unfortunately not happen. So it may be slightly different to all the videos you're used to this year so far, and I'm going to try my very best to give you as close as possible to the experience you would have had in the classroom today. To start off with, we remember that we said that the purpose of the lecture today was to go through the lessor's accounting for a finance lease, and we're still busy working with Maddie Collector Limited, which was the 2012 exam question and the question that you worked in class through as a class test last Thursday. Just to recap on the information quickly, which you should have with you, but will also be on your screen now. If you need to pause to jot any of this down for whatever reason, take a moment to do that. The most important parts of the lease term arrangements are given to you now on the screen with the 5-year lease term, the payments. Remember, we said that 4,000 Rand really doesn't have much to do with leases. So you're actually looking at a lease payment of 50,000 Rand, and I'll be concentrating on that 50,000 for the rest of these videos. The 4,000 just being an expense related to the inspection of the machine down the line, and I think it's 18 months' time. And then you're given the fair value of the machine that's being sold. Remember, Maddie Collector is your lessor, and the lessee is Upstart Toys Limited. And then your guaranteed and unguaranteed residual values. So proceeding from this, let's consider just the basic journal entries that we did in class yesterday for the lessor to account for a finance lease in his books. And first, perhaps, let's go to the event. The event in this case is something is being sold. There is some other asset being sold. So you'll be looking again at other inventory being sold, which if that is the case, you will have your debits and credits. And then obviously you are selling inventories, which may be your main business. In this case, it's the toy manufacturing business. So your revenue would be credited, and it's not a cash sale. It's effectively on account and legally in the form of a finance lease. So you may have your finance lease debtor as the debit entry. Then, given that it's a sale of inventories, you'd be looking at, if it's the perpetual inventory system, there would be a transfer to cost of sales from my inventories account. So back to IAS 2, you would take it out of inventories, credit your inventories, and debit your cost of sales. If it is periodic, obviously this entry would not occur, and it would be adjusted for at the end of the year with the closing inventories. So that would be the instance if this had been the sale of inventories. In the example we've been working through with Maddie Collector, it was actually the sale of an item of property, plants, and equipment. So that will again be your usual asset disposal journal entry. Your proceeds again though being a finance lease debtor, and you're selling an asset, so you would be wanting to transfer the cost of that asset out. You'd be wanting to transfer the accumulated depreciation on that asset out, closing those off to the asset disposal account. The proceeds less the carrying amount there would then give you your profit or loss on the sale of the asset. So in principle that is the basic journal entry that one would be looking at. Now, remembering in South Africa, we seem to be doing the journal entry targeting more towards the disclosure and the note rather than traditionally the case of presenting financial statements. So, although in your financial statements, in terms of IAS 17, you're going to present this finance lease debtor, we in South Africa capture the effect of that by doing two journal entries. So, we would be creating what they call the gross investment in the finance lease, which you'll remember is all the payments added together on this lease. And then because those payments include a capital and an interest portion, we then have to recognize that we've actually got unearned finance income in that debit. So we credit the account with that. The net effect of these two giving you then that finance lease debtor that the rest of the world tends to do when they're doing the journal accounting. So it is something particular to South Africa, and I haven't observed in textbooks outside of our country. The journal then proceeds again, it's an asset disposal in this case, so you've got your proceeds, which be the net of this gross investment and unearned finance income. Get rid of the cost of your asset that you've disposed of, the accumulated depreciation is transferred out, and you now can recognize your profit or loss in this journal entry. So that is just a quick recap of the basic journal entry that you will find for finance leases in the lessor's books. We'll now proceed to take it through to the information in Matty Collector.